Hello everyone, welcome back. So in this video, we will continue with the chapter 9 of our accounting 210. So we will try to finish our operating budget. We still have the last part to do, which is the operating expense budget. We said operating expense is all the like sales and general administrative. Those are period costs. We have to expense them the same period. So what does this company have for the operating expense? Um, so the first part basically just tells us what is operating expense. We already knew this from our first exam, right? From chapter 2, chapter 3. The first item we say is the sales commission, sales person salary. We focus on the sales, right? We focus on the sales. Remember when we do our production budget, we use the production units. We said we plan to sell 3,000 units, but we plan to only produce 29,000 units because of the ending inventory and the beginning inventory. So we use 29,000 units to do all the direct labor, all the direct material, and then also for the manufacturing overhead. But now when we do our operating expense, we use our units to be sold. So we plan to sell 30,000 units, and then sales commission, they get $1.5 whenever they sell one case. So totally our sales commission for January will be $45,000. And then we also have shipping expense. Each case will take $2, so we have this shipping expense of $60,000 in January. One thing I want to point out, which is kind of important for the operating expense budget, if I test you, I think this will be the one. We call it credit sales bad debt expense. Remember, if you have learned financial accounting, you do not collect all the credit sales because someone, they just, run out of cash, they don't pay our credit. So we have the risk of not collecting our credit sales because the bad debt expense. I hope you still remember that part. So now, remember when we do our sales budget, at the very beginning when we do our sales budget, we listed our sales budget to the cash sales and then also to the credit sales. We said that totally our sales revenue will be 600,000, and then 20% will be cash sales, and then 80% will be credit sales. So January we have credit sales 480,000, but we expect that 1% of our credit sales will be bad debt expense. So, okay, what is important I want to point out is that this is so easy, right? But it's 1% of only credit sales, of just the credit sales. It's not the cash sales, right? Cash sales doesn't have the bad debt. Okay, it's not your total sales. Our total sales is 600,000. Not 1% of that. It's just 1% of our credit sales. It's just 1% of our credit sales will be that bad debt. So this is important. Some students, they just use 600,000 or they use cash sales. No, you only have a bad debt expense from your credit sales. Promise me you will get this one in the multiple choice if I test you, okay? So you have this bad debt expense is 4,800 from January. So if we do this, those are the variable operating expense. So we look at everything one more time. We based on our sales of 30,000 units. So you have sales commission, you have shipping, you have a bad debt from your credit sales. You have a bad debt from your credit sales. So your total will be just the first quarter, you just add everything together. This gives you a variable operating expense. Remember, we also have the fixed operating expense. salaries, office rent, depreciation, advertisements, other things I'm not going to read. But similar with the manufacturing overhead, you can say each month is the same because it's fixed. So each month we have fixed operating of 33,000, 33,000, 33,000, 99,000. So our total operating expense is our variable 109,800 plus our fixed 33,000. January we have operating expense $142,800. Okay, we got everything ready. Now we just need to do our income statement. I'm not going to really test you. I think I made a mistake in the first video, but general idea is sales revenue from the sales budget. You get cost of goods sold from your production budget. You know, you have the direct labor, direct material, and manufacturing overhead, but you have to use the portion that is just sold. So the difference, we call it the gross margin, gross profit. I think I made a mistake at the beginning. We call it the gross profit and the gross margin. So we minus all the operating expense, we minus all the operating expense, we get our operating income. So we stop here. I don't really worry too much about the tax part. So that will give you our budgeted income statement. That gives you budgeted income statement. So I think we are finally done with the first part. I want to go back to this chart with you one more time. I want to go back to this chart one more time. And then you can say, now I hope you have a better understanding. We start from sales budget, then we get how many units we have to produce. From that, we get direct material, direct labor, and then manufacturing overhead. So we also have other operating expense budget. Then we got our budget income statement. That we got our budgeted income statement. Okay, let me know if you have any question. Next time we will talk about our the financial budget. You can say they don't have so many things. Actually, just the cash budget is the main one. We don't have so many budgets, but cash budget is kind of tricky and confusing. So we focus on that one in the next videos. And then let me know if you have any question. Thank you.